A common belief about retirement is that your taxes are going to drop. And that can be true, but one of the biggest surprises that a lot of retirees find is that taxes still play a pretty prominent role. So just because the paycheck stopped, of course, doesn't mean the IRS has forgotten about you. But the way that your income is taxed can influence how much you get to spend, how long your money lasts, and even how much of what you leave your heirs actually remains with them. I've noticed there's some common questions that come up pretty frequently. So I just wanted to go over 10 of the most common tax questions that I hear and give you a brief overview of each of them. So the first, will I owe taxes on my Social Security benefits or some variation of that? How are they taxed? So a lot of retirees do expect that their Social Security benefit is tax free. And that actually is true for a lot of retirees, but it's not always the case. This is a very individual thing. So whether your benefits are taxable depends on something called your combined income. So this adds up your adjusted gross income, any non-taxable interest you get. So, think municipal bonds, and then half of your Social Security benefit. So once that number starts crossing certain thresholds, a greater portion of your Social Security benefit becomes taxable. So up to a maximum of 85% of your benefits might be taxable. And this often catches people off guard, especially if they're also drawing from other sources like IRAs or pensions. Oftentimes, even the people who do know about Social Security taxes misunderstand where they fall, and they're often either, paying much more or much less in tax on their Social Security benefits than they think. So the second one is, how are required minimum distributions taxed? So once you reach the required age, which is 73 for most retirees right now, you must begin taking withdrawals from traditional IRAs, 401ks, and other tax-deferred retirement accounts. These withdrawals are taxed as ordinary income, and depending on the size of your accounts, they can push you into a higher tax bracket or just disrupt your own withdrawal plan because, again, they're required. So planning ahead, sometimes even years before you retire, can help you avoid them or reduce them in a way that can help mitigate your tax bill and just increase overall efficiency in your plan. And then give you more control over your distributions, especially later in retirement once RMDs become much larger. So the third one, are Roth IRA withdrawals really tax-free? Generally speaking, yes, they are. Withdrawals from a Roth IRA, especially for retirees, are tax-free as long as you meet two requirements. The first is that you're at least 59 and a half. So, most retirees satisfy that. And then the second, it's been at least 5 years since you first contributed to a Roth IRA. And again, that's true for most retirees. Outside of those conditions, it gets a little more complicated. I don't want to go into that here because, again, the majority of people simply satisfy both of those in retirement. And because Roth IRA withdrawals don't count as taxable income, and they aren't included in your combined income for Social Security, they can really help balance out your other income sources and keep your taxes just, overall lower in retirement. All right, the fourth, should I do a Roth conversion in retirement? Roth conversions allow you to move money from a traditional IRA or tax-deferred retirement account into a Roth IRA. Of course, you pay taxes now at the time you do the conversion, but then the benefit there is that you get to take tax-free withdrawals later from the Roth IRA. As we just discussed, this can reduce your future RMDs because it's reducing that tax-deferred balance and give you more flexibility. But conversions increase your taxable income in the year you do them because, again, you have to pay taxes on the conversion. So they're not always the right move. The best timing depends on your current and future tax brackets and your long-term goals. And again, it's going to be different for everybody. Number 5, what tax breaks are available for retirees? So there are a few perks that come with age. So as they relate to retirement, some tax breaks that you can get. For instance, there's an additional standard deduction once you turn 65, and even a new additional standard deduction with the one big beautiful bill. You may also be able to deduct significant medical expenses once they start exceeding a certain percentage of your income. So, as you incur those expenses, you may start, having more tax deductions for them. And depending on your situation, there are other credits and deductions available, but you need to know which ones apply to you and how to claim them. So, for example, here in Gregg County, there are property tax breaks for people who are 65 and over. All right, number 6, how do state taxes affect my retirement income? This is another one that has a varied answer. Federal taxes aren't the only piece of the tax puzzle, obviously. Some states tax Social Security, pensions, or IRA distributions, and others don't. It just varies from state to state. Texas, however, we don't have a state income tax at all. So obviously that's not an issue here. So if you're considering moving in retirement, right, either you're coming into Texas, understand we don't have a state income tax, or if you are moving out of Texas, and into a state that may have a state income tax, it's important to check and see how those retirement income sources may be taxed in that state. All right, 7, how are pensions taxed? Okay, if you're fortunate enough to have a pension, I know, a lot of jobs don't offer those anymore. Those payments generally are taxed as ordinary income at the federal level. Again, state rules vary. Some allow exclusions or credits for pension income, but again, no state income tax in Texas, so not something that Texans have to consider. Most pension plans also let you set up tax withholding, and I think that's important because it can help you manage your cash flow and help you avoid any surprises or underpayment penalties in retirement. So I would take a look at that. All right, number 8, do charitable contributions reduce my taxable income? And I think here most people have an understanding that they do. Okay, charitable giving can help you reduce your taxable income even in retirement because again, they're generally tax deductible. But you may have different ways available to you in retirement that can make it even better. So for example, qualified charitable distributions. If you're at least 70 and a half, if you make your charitable distributions directly from your IRA rather than, giving cash, say out of your checking account or cutting a check to an organization, that can be even better. QCDs do count toward your RMD requirement, but they aren't included in your adjusted gross income. So the tax situation for a QCD is a little different and a little more beneficial as opposed to regular charitable contributions. All right, which retirement account should I withdraw from first? Very common one, right? Especially as you're in that transition into retirement. So not all retirement accounts are taxed the same. So if we're thinking about this from the tax perspective, the sequence you choose, such as whether to draw first from taxable brokerage accounts, traditional IRAs, or Roth IRAs, can make a pretty big difference in the amount of tax you ultimately pay. But here it's important to think about it not just in the year that you're making the withdrawal, but looking at your total retirement withdrawal plan, right? So considering, if you withdraw from one account first, what does that mean down the road? Generally, I like to start with taxable accounts, but then couple that by doing partial Roth conversions over time, so that you aren't left with a significant tax deferred balance later in retirement. That can be a very tax efficient imbalance. But there isn't a single best answer that fits everyone. Okay, this is just simply one of those things that it's an individual, depends on you and your circumstances. The right withdrawal strategy just depends on your income needs, tax bracket, and even your estate planning goals. All right, 10, another kind of hot button one. Will my heirs owe taxes on what I leave them? Leaving financial assets to heirs is a priority for some retirees, and it's not for others, right? And again, that's different for everyone. But even for retirees that don't have this as a goal, they may still end up leaving money simply because they don't spend it all. It's again kind of a balancing act, right? So, regardless of your approach, misinformation about the tax rules for heirs is very common. So, I think it's important to kind of clarify. Inherited IRAs are now subject to a 10-year rule for most non spouse beneficiaries. We used to have what's known as the stretch IRA, but that's gone now, again, for the vast majority of non spouse beneficiaries. So this means your children may need to withdraw the full balance within a decade. So while they may not, owe taxes immediately, just understand that, if they have a tax deferred account that they inherit, they're probably going to be distributing that over a condensed timeline. So obviously that's going to create some tax issues for them. On the other hand, assets in taxable accounts generally are going to receive a step up in basis. So this can minimize or even eliminate entirely the capital gain tax for them once they start selling those assets. So understanding those rules ahead of time can help you leave assets in the most efficient way possible if that's a concern for you.